All right, welcome back, fail-safe investors. Today you're in for a real treat. I'm doing a comparison video again like I did last week when I did PayPal versus Square Inc. And it's kind of a coincidence that this comparison video will also be two payment processing companies. So in today's video, I'm going to compare Discover Financial Services to Visa Incorporated. And if you haven't been watching my videos or been keeping up, I already did an analyst video on both of these companies individually. So I'll leave the link in the description for those videos. So you can go back and watch them so you'll know pretty much what's going on and what I'm mentioning in the topics in this video. But a disclaimer, I am not a financial advisor. I am just giving my advice on these companies. And I should mention before I go into this video that I do personally own one of these stocks. So let's just see if you can guess which one. Let's go. Okay, right off the bat, man, the boy got dollars. No, I'm just playing. So before we look to these companies, we want to ask ourselves three questions. What are the profitability of these companies, the sustainability of these companies, and the value of these companies? And then you, the viewer, are going to be able to answer that question on your own, hopefully by the end of this video, and come to a conclusion on your own, and also have the confidence to invest on your own at the end of this video. So let's get right into it. So first off, before we ask those questions, we gotta, like I said, you gotta understand the company that you're looking into. If you haven't seen the video that I've done earlier this week on Discover Financial Services, you can go back and watch that. But if you haven't seen that video already, pretty much the gist of it is Discover makes their money through primarily their credit card interest. So they are a bank. Discover is a bank. Visa isn't a bank. So while Discover brings in 85% of its revenue from the interest made on the credit card payments, Visa makes its money just from people using its service. It's a network service pretty much. It's a trusted network. It's part of the most trusted network in the credit debit card service industry or the financial payment service industry, because both of these companies pretty much facilitate money. Also, what gives Discover the upper hand is Discover is a bank. So Discover can use Discover can pretty much monetize the money from its deposits that it have in its bank accounts and sell that to raise capital. So that is one advantage that you would have to give to Discover in this case. As in Visa, they don't really have too much to leverage to raise capital other than issuing bonds and saying that with the promise of we'll pay you back plus the reigning champion of the payment process of the world, with over 3 billion accounts, with over $11 trillion processed, Visa. Yeah. Woo, 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 woo. Yeah. Testing, this thing on. All right. The fourth largest card holder in the world. Oh, sorry, America. With the #1 cashback rewards, no annual fees, the third largest student loan issuer in America. I gotta give it to him. Underdog, tonight's contender, Discover. All right, so let me hit you with a couple facts before we get right into this. So we're gonna start with Visa since Visa is the larger between these two companies. So Visa, ticker symbol V, share price $181 last time I checked, market cap $380 last time I checked, and a price to earnings ratio of 31. Not bad, pays a dividend of 0.67, so that's about 67 cents to every $100, and has a earnings per share of $5, a little over $5, at $5.48 from last year, or trading the last 12 months. So that's not a bad company. And they also brought in a total revenue of $24 billion last year. So it's a really good company, but now we're gonna look at Discover. So Discover Financial Services, ticker symbol DFS, has a market cap of $13 billion Last time I checked, a price to earnings of 6. The share price is $41 at the closing bell of April 30th, 2020, and a earnings per share of $6 from the trailing 12 months. So they brought in $6 per share last year and pay a dividend yield of 4%, a little over 4%. You can look it up, might be wrong. But Discover brought in $14 billion total revenue last year. So it's not bad compared to a company that is more than 4 times their size. Okay, so when it comes to profitability, in my opinion, I'm gonna have to give this one to Discover. And the reason I'm gonna give it to Discover is because when you look at the market cap that Discover have of 13 billion, which isn't a crazy or very large market cap, 13 billion, they have room to go up from there. So they have a market cap of 13 billion, but was able to bring in a total revenue of 14 billion. So they made more revenue than their entire market cap. And then you look at Visa that has a market cap of a little over 380 billion, which is considered very large market cap, and their revenue was 23 billion. That's one. The reason I give to Discover in this case is because they're bringing in a little over half the revenue of Visa with a very small market cap, or a market cap that's very small relative to Visa, pretty much. So I would have to give it to Discover in the case for profitability. They just make a really good case. They bring in a lot of revenue for the market cap size that they have. And then when you consider their payouts and expenses, it's also low relative to Visa. So there's more room for growth with Discover than it is. Okay, so then we asked the second question, sustainability. Which one of these companies can you see lasting for the long run? And that's going to depend on a couple factors. So like I've mentioned in the video that I did on Discover earlier this week and Visa this week, was their biggest competitor or risk factor right now will be cryptocurrency, because both of these companies offer a way for you to have your entire wallet in your pocket, and they charge a fee to facilitate that transactions through a debit card or credit card. So with cryptocurrency, it kind of eliminates the need for a bank, and then you just don't really need a debit card. Now you probably still will have credit cards in the future, but there is no debit card. So then I don't know how much of Visa's income comes from their Visa versus their credit card, but I know that Discover, big part of their revenue comes from their credit cards. So I don't see the need for credit cards going anywhere anytime soon, because people will always use debt. People have been using debt since forever. People will always use debt to grow themselves, or like big payments and then put it off, and then Discover charge an interest on that, and they make the interest fee or the interest, and they make the money from the interest payment. So sustainability depends on a lot of things, but even though Discover might look like it can go longer in this run, I might have to give it to Visa, just because Visa is the #1 global card holder. Like pretty much everyone has a Visa. Visa is accepted everywhere. They have the most reliable network. So as far as the long run, I would, in my opinion, I would have to give it to Visa. Plus Visa was the one who pioneered the electronic card service. So you got to give it to Visa in this one. They're staying innovative. They're constantly buying companies up to expand their network. So as far as sustainability, sorry, I got to give it to Visa. Let's go. Okay, so then when it comes to value, we're going to look at a couple things and try to ask ourselves which one of these companies we can get a bigger bang for our buck. So with the value question, it's kind of going to tie into profitability. So when we look at the price to earnings, the earnings per share, and the dividend of both of these companies, and compare them side by side, I personally would definitely have to give it to Discover. So as far as value, meaning what you're paying right now for the per share versus what you get in return, the reason why I would give it to Discover is because right now Discover has a price to earnings of 6, which is good, a earnings per share of $6 from the last 12 months. So last year in 2019, Discover brought back in $6 per share, pretty much, which is amazing for any company. And then even right now, and what's going on right now in the world with the slow economic downturn, Discover is still paying a dividend yield of 4% when a lot of companies cut their dividend. So then when you take all of that info and then you compare it to Visa, Visa has a price to earnings of 31, which in my opinion I would consider that high. But their earnings per share was like $5, which is amazing also. And then you look at the dividend pays 0.67%, so that is really low. So for every $100 you have, you're gonna get 67 cents back versus the $4 for every $100 versus the $4 for every $100 you have in Discover. So the last thing I want to mention is Discover is trading around $40 or $41 a share, and Visa is trading around $181 a share, or $180 a share. So let's just say you had $200 to invest. If you invest $200 in Visa, you get 1 share. You invest $200 in Discover, you can get about 4 to 5 shares depending on where it's trading at in that day. So now let's say that both of these companies' share price go up just $10. So if they both go up just $10, which is a small or large movement depending on what company you're looking at, $10 for Visa, you have a $10 profit based on the amount of shares you have. $10 in Discover, you have a $40 to $50 profit depending on how many shares you have. So the value, as in like, for me, value meaning like the bang for your buck and holding on to these companies for a long term and watch them grow, I'm sorry, you know, I gotta give it to. I gotta give it to Discover. It just is what it is. But hey, that's just my opinion. I really suggest that you do your own research before you think about putting money into either one of these companies. Now, I know I'm always the one that's preaching financial statements, balance sheet, income statement, cash flow statement, all of that good stuff. But for the purpose of today's video, we're not gonna dive that deep into these companies. This is just to pretty much give you a picture of these companies, how they operate, what risks they might have in the future, the growth potential, the sustainability of the company, the value of the company, to see if it's worth paying what the market says it's worth. Because like I've said, the price that's showed on the chart does not represent the actual value of the company. You have to look at that. But so today's video, we're not gonna, I say that to say, we're not gonna get into the financial statements in this video. Instead, I've already went into both financial statements of both of these companies. Like I said, I'll leave the link to those videos in the description below. And that's another episode for Failsafe Wealth. My name's Terry. If you haven't already, hit the subscribe button, hit the like button, please and thank you. And that's it. Let's get it, let's do it.